Biden inflation, existing home sales plunge while skyrocketing prices keep breaking records. We are about to experience an absolutely epic housing crash, the likes of which America has never seen before. How about this headline? The San Francisco Chronicle headline screams, it's official. Bay Area home values are finally going down. But in the article, it is not that at all. The slowing demand has yet to translate to notable declines in home prices in the Bay Area. So what does that mean? The article continues, there was a slight month-over-month decrease in typical home values from May to June for 5 out of the top 50 largest metro areas. So what is slight? How about 0.1%? And not to get too technical, but it could be as low as 0.051%, and that's rounded up. And more important than a 0.1% change in either direction is whether that signals a trend line. Well, if you look at the graph of changes over the last 5 years, you'll see that there have been several times along the overall increase where there was a small pause. Do you see the confusion with these articles and the panic porn that's being pushed? We'll continue. Further, the article mentions that the Bay Area metros declining are part of 5 metro areas out of 50 declining. So are the rest flat? Are 5 of the other 45 increases, 10 or more increasing? And this is the exception. The article, curiously, does not give us that data. Interesting. So is the trend in these 50 metros even indicative of the market as in a whole? For example, may it be a big city issue or certain cities? For example, last week, Starbucks announced it is closing stores in LA, other major West Coast cities. Starbucks plans to close 6 stores in Los Angeles area and 10 locations in other major cities because of what it says are safety issues, including drug use, threatening behavior. So is this decline in metro areas a sign of increased crime in metro areas and not indicative of overall real estate trends? We don't know. We don't know. So when you read all this stuff, you may not want to buy a house right now. What goes up must eventually come down. And we have just entered the downside of the equation. So when you read these articles, over the past 2 years, home prices in the United States have gone up nearly 41%. We've been spoiled. Now mortgage rates are rising at a pace that is truly frightening for some people, and they are likely to go even higher in the months ahead as the Federal Reserve continues to fight its relentless war against inflation, and they called it transitory for over a year. Needless to say, higher mortgage rates mean higher potential mortgage payments for prospective home buyers, so millions of Americans are being priced out of the marketplace right now in the lower end segments. That $500,000 mortgage at 3.1% is $2,100. At 6%, it's almost $3,000. So the only way you're going to bring those buyers back into the marketplace if home prices come down, and it's starting to happen in certain parts of the nation, you have to look at this data creatively and between the lines. Every week I do my research and I do a YouTube search on the term real estate crash. This week it got over 74 million hits on that search. Lots of sad faces, lots of scary thumbnails. You have to look at both sides of this. According to CNN Business, foreign buyers are slowly returning to the U.S. housing market. 44% of foreign buyers pay in cash compared to 24% of U.S. clients. I'm hearing the same thing. And I'm hearing that same sentiment from my global contacts. So, yet it does not, seem we are headed there, yet. But, we have a lot of people that don't work in the real estate industry pushing panic porn, in my opinion. Yes, at the same time, there are people providing information in their respective industries that don't have a clue. So one guy that I just listened to doesn't work in real estate sector. He said he pulled all the research and pulled all the data together, and you can make your own opinion. We looked at the Mortgage Bankers Association, Freddie Mae and Freddie Mac, and what the Federal Reserve out of Atlanta is saying, blah, blah, blah. By the way, they've been wrong in the past, Fannie, Freddie, Mortgage Bankers Association. So let me just throw it out there to you. Would you feel more comfortable giving $10 million to someone to invest for you that has a proven track record of, let's say, working at a top investment bank like Goldman Sachs or William & Blair, is a certified financial accountant. By the way, it takes 1,000 hours to study for that test. It's very hard to pass. Has a Series 7 license, won countless awards in investment banking industry, and top of that is currently managing billions of dollars and has a global real estate portfolio. Or would you rather take the real estate advice from someone who is a licensed real estate broker, let's say in multiple states, a certified probate expert, certified property manager, currently running a $41 million real estate portfolio for 2 high net worth individuals, and has a personal portfolio of properties that he or she owns, and has a global network in place with other brokers, investors all over the world to get a pulse on what's going on in the market? No, Tim, I'd rather take that advice from the YouTube guy that does not work in the industry. They are talking, they know what they're talking about. The reason I say this in tongue in cheek, be careful. Look at someone's track record of success and the industries they have worked in. For example, we have a brag book. Be more than happy to share it with you. A list of everything that we've done and properties. So in order for there to be a real estate crash, there has to be more sellers than buyers for prices, not listing prices, but prices of houses to go down. And inventory levels remains at historic low levels, yes. So, a national study released by Up for Growth found that 47 states, the District of Columbia, and 169 out of 309 metropolitan areas have a housing deficit. Nationwide, the study found that housing underproduction has reached 3.79 million units, up from 1.65 million units in 2012. And as long as there are not enough houses, there cannot be a crash, period. Okay? Another misleading headline this week, and it just continues, I could go on, is in CNBC. Home buyers are canceling deals at the highest rate since the start of the pandemic. Great soundbite. Again, this sounds scary, right? But let's break it down. The data they are reporting says that the cancellation rate went from 11% to 15%. This means that out of 100 escrows, 15 were canceled last month from only 11 a few months ago. Yet 85 still closed. Is that number high? Well, it is the highest during COVID, but that was an unusual time. Despite the massive rise in rates and other social disruptions, the percentage of escrows that do close is higher than any other time, during COVID. So again, just fear-mongering. Based on a lot of research and data and talking to people, let's review some of the numbers and you can decide for yourself. You have to look at the macro, the micro, talk to people in other markets, regionally, nationally, globally. You just can't paint a broad brush and say this is what it is. Certain markets will be affected, others won't. You just can't rely on spreadsheets. You better have relationships with brokers and investors in the markets as well. Get on the phone to get the real picture. Talk to real people. Don't just look at a spreadsheet. So look at this map about overvalued markets. For example, take Boise, Idaho. Boise was one of the hottest markets in the entire nation, but now sales are dropping faster than Joe Biden's approval rating. Before governors relaxed stay-at-home orders 2 years ago, white-collar professionals were already fleeing their exorbitantly priced apartments in like cities in San Francisco, Seattle, buying investment property, moving down to Boise, just like people in New York went down to Florida. So the biggest beneficiary of that, WFH home buying wave was undoubtedly Boise, where home prices skyrocketed 53%. You can even call it the poster child of the pandemic housing boom. But that Boise honeymoon is over. I had a friend's client, took his whole portfolio into Boise last year. He doesn't care, he paid cash. So with spiking mortgage rates have pushed the overall U.S. housing market into a slowdown, it has delivered a particularly hard blow to Boise housing market. That has seen both Boise home sales plummet down 28% on a year-over-year basis, and inventory levels surge up 161% this year. So it's also chipping away at home values. According to Zillow, the median Boise home sales price fell roughly 3.5% in June. So you have to look at this reasonably. What is happening in Boise is not happening, for example, nowhere near the same scale as Bel Air, California. So check out this chart in Bloomberg about California. The pace of California home sales went down in June from a year earlier as soaring mortgage rates took a bite out of buyer interest. The State Realtors Group reported Monday. So, however, you have to look at this chart. look at the segment with the biggest dip. It was people buying $0 to $299,000 homes at minus 48%. You can't just look at this holistically. I'm working with clients on a global scale and talking to individuals working with clients on a global scale daily. So for example, I have a Midwest client that is finalizing the sale of his company in 2 weeks, and he wants to put $9 million in real estate properties, investment properties. I'm going to help him do that. He sees the value of hard assets in this market. Remember the disaster at WeWork? The former CEO walked away with $1 billion and he put it all into real estate. Yes, Compass, Redfin brokerages have had layoffs. However, it's not the full story. That's not the case across the board. Take, for example, At Property CEO Thad Wong says he's looking forward to a downturn. The Chicago leader of the Chicago-based brokerage said he's better positioned than Redfin, Compass to grow into a changing market. We feel the same way as Mr. Wong about our business model going forward. So Thad, I'm looking forward to maybe seeing you in Las Vegas the first week in August. Maybe we can have a cocktail. Fears that a recession is looming have pushed down yields on long-term bonds. You know, as I stated in another video, Elon Musk said, we need a recession. We need a recession. So what is a recession? Just a period of temporary economic decline during which trade and industrial activities are reduced, generally identified by a fall in GDP for 2 consecutive quarters. We've had one. So what did Musk say exactly? He said a recession is part of the economic cycle and is natural to go through it. It's natural to go through it. We got to get rid of all these bums anyway. And he mentioned the 3 Ps. Number 1, predict. You got to stay multiple moves ahead. Number 2, prepare. Get ready for what is ahead. And number 3, keep pushing and find a way to make it through. We are at that phase and where this is very important. I agree with Mr. Musk's 3 Ps right now. Yes, people are concerned, but the individuals that are ready for this downturn, they see this as a golden opportunity to add new wealth to their portfolios. People I'm talking to, my clients are buying real estate globally and will continue to do so in a down market. We're seeing rental for vacation homes up. Home sales are still incredibly brisk. On average, a home remained on the market for 14 days, down from 16 days in May. Before the pandemic, it was typical for a home to remain on the market for a month or so. Finally, there are more homes on the market. Interestingly, though, the record low pace of days on market implies a fuzzier picture on the home prices. Home prices, home price right are selling quickly, but homes priced too high are deterring prospective buyers, and that is key. Homes in certain markets are priced too high, and they're going to come down. So by historical standards, rates are still low. I did a video a while back and I stated rates could go to 10%. Some of that was tongue in cheek, but the data I was looking at, I was pretty clear it was going to go over 5. The Fed is unpredictable and have been caught lying about inflation, calling it transitory. They got political and they should be a neutral body. I don't like that. They got political. The average, rate on a 30-year fixed mortgage fell to 5.30%, down from 5.7% last week and 5.81% in the week before that. Mortgage rates tend to be closely tied to yields on the 10-year U.S. Treasuries, which compete with mortgages for investor dollars and are considered the safest asset in the world. So on Monday, the yield on a 10-year Treasury fell to 2.78% and the lowest since May. So many investors had expected the Fed to continue to hike rates throughout the middle of the next year, bringing its target to 4% or more, with signs that the economy is slowing more than expected. That expectation has come down. So market prices now indicate the Fed will stop hiking when its target is below 3.5% and may even cut rates to stave off a severe economic downturn next year. So for example, the article won't tell you this. I can personally get 4% rates on a jumbo loan, and some lenders on a conventional loan I get in the 4% range as well. See, you won't hear that from these articles these people write who don't work in the industry. And they're not players and they don't have the ear to the ground. So yields fell when bond prices rise. So when investors bid up safe haven assets like treasuries, yields decline. This tends to send mortgage rates lower. Over time, yields on longer term treasuries reflect the expected path of short-term U.S. government debt and the Fed's target for the overnight bank funding rate. So higher interest rates and very high home prices drag down demand for mortgages for the third straight week. That's from the Mortgage Bankers Association, a few other places I look. Sales of previously owned homes in the U.S. fell by more than expected in June, and the fifth straight monthly decline to the lowest levels since June 2020. That's from the National Association of Realtors. Economists, from my research, had forecasted around a seasonally adjusted annual rate of 5.4 million sales. Instead, they fell by 5.4% to 5.12 million. Compared with a year ago, home sales were down 14.2%. So interest rates have dramatically moved up over the past year alongside home prices, putting home purchases out of the reach for some would-be buyers and convincing others to hold off on purchase in some segments of the markets. That $500,000 mortgage at 3% is $2,100. At 6%, it's almost $3,000. So some owners may be reluctant to sell a home with a lower mortgage rate, knowing they will have to pay a higher rate on a new home. So bottom line, if consumer price inflation continues to rise, the mortgage rates will move higher. Rates will stabilize only when signs of peak inflation appear. If inflation is contained, then mortgage rates may even decline somewhat. So there was some relief when it comes to the inventory of homes for sale. Compared with May, the number of homes on the market rose 9.6%. Compared with a year ago, the number of homes on the market is up 2.4%. So the first year-over-year gains in 3 years. So sales were down in the West, the South, Midwest. In the Northeast, sales were unchanged. Economists had forecast around a seasonally adjusted annual rate of 5.4 million. So, it was down a little bit. Mortgage applications fell 6.3% for the week ending July 15th, and that's 2022. So applications for a mortgage to purchase a home dropped 7% for the week. Compared with a year ago, applications are down 19%. When we talk about refinance, which our refinance is extremely sensitive to mortgage rates, continue to fall. The refinance index fell 4 percentage points from previous week and is 80% lower than a year ago. So you look at those mortgage applications, they declined for a third week in a row, reaching the lowest level since 2000. Similarly, most mortgage rates more than 2 percentage points higher than a year ago. So demand for refinances continue to go down. And the refinance index is falling to a 22-year low. So the average interest rate for a 30-year fixed mortgage with a conforming loan balance, so it's got to be roughly $647,200 or less, increased to 5.82% from 5.74% from a week ago. A year ago, the average rate was 3.10%. The average interest rate on a 30-year fixed rate, mortgages with jumbo loans, they said they went up to 5.31. I'm talking to my lenders, we get in the 4% range. I get in the 4% range on a 30. So there you go again. Just don't read the article. Competent real estate professionals will get you better rates. There is no way that this could continue for this long, these home prices, and we have reached a point where home prices in the United States are somewhat overvalued. And I look at both sides of this, okay, in certain markets by 25%. So the analysts conducted by Moody Analytics aim to find out whether economic fundamentals, including the local income levels, could support local home prices on a national level. And Moody Analytics finds U.S. home prices are overvalued by about 24.7% in certain markets. In other words, U.S. home prices are 24%, roughly 24% higher than they would be historically traded at a given current income levels. So does that mean that home prices will go down by 25%? Well, it all depends, in my opinion, on what the Federal Reserve chooses to do. As I said earlier, if you look at where home prices went up over the last 2 years, if the Fed decides to stop, raising interest rates by the end of this year, the damage could potentially be minimalized. But if the Fed continues to raise interest rates throughout 2023, we are likely to see some carnage that, is unlike anything we've seen before. Everything depends on the Fed. Remember, if you're waiting for the government to save you, they won't. You have to save yourself. A decade ago, countless well-heeled economic prognosticators didn't think that the Dow Jones would ever break 30,000 and stay there, or that oil could drop below $50 a barrel for years. So it's entirely possible that home values will continue to appreciate and provide millions of Americans with billions of dollars of found money as long as supply shortages persist. More and more millennials and Generation Zers have families and amass the financial resources to buy into the American dream. We do have outliers, though, that are concerning. Despite the fact that wages, long ago stopped keeping pace, and that's what I feel. Wages long ago, based on the data, stopped keeping up pace with housing costs. Most younger first-time homebuyers, have locked themselves into conventional loans at historically low rates without ballooning adjustable mortgages, and buyers paying cash won't risk defaulting on their properties in the first place. We've had a lot of cash buyers in the last 2 years. So the key difference now versus during the housing bubble before the Great Recession is that back then it was easy credit that fueled speculation, not cheap credit. It wasn't uncommon for buyers to put nothing down and speculate on real estate because all they had to do was fill out a few pieces of paperwork and no one cared about the actual numbers. It was unbelievable. This time around, the demand that's fueling, appreciating prices is real, from families, newly remote workers, and companies relocating employees to lower tax, lower regulated states. I believe the market will not have a soft landing in the next 6 to 24 months. But that said, with the right toolbox and the right tools in that box, you'll be able to capitalize on all the craziness in this market and make some serious money. Remember, real estate is like boulders and the stock market is like water, okay? Whether the market is up or down, people will always buy real estate no matter the market conditions. This is an opportunity, folks. I think Warren Buffett said it best. When the tide goes out, you'll see who is wearing their swim trunks. This is an opportunity. I'm seeing both sides of this. Purpose of this video, there's a lot of panic porn out there. And when you break down these articles, you got to break it down. And what they're saying holistically is not panning out. And it's frightening a lot of people. And I could go article after article. But also, we're in for some corrections in the market. There's a lot of moving parts with what's going on globally, the war, the interest rates, the unemployment rate, say is historically low. We count part-time workers. A lot of six-figure jobs are not there. They're counting low-end jobs. And we all know, if you studied the unemployment rate, the history of it, how it's manipulated. So there is concerns in the marketplace, but the thing is, you can't look at things nationally. You have to look at things regionally, and you can't get that from a spreadsheet. You can somewhat get it, but you're going to get it from a real estate professional that is talking to people that covers these markets. There's, for example, a lot of off-market deals in the last couple of years that aren't even reported through the MLS. It's incredible. I'm working with clients that are pumped to buy real estate right now in other markets outside California and Nevada, and I'm talking to people in the Midwest, in the East. So, I'm not seeing a lot of these trends for people. Yes, 330 million people. We have 100 million people on some type of assistance. 88 million people out of 330 million people have some serious money to play with. So, there are some concerns in this market, and but you have to look at all avenues and not just get all your information from a spreadsheet. You have to talk to people that work in the industry to get a real perspective, because I was going through these articles and that's not right. And I got 12 plus articles that I went through. So have a great week. It's not as bad as they're saying, in my opinion, but prepare. There will be a correction, and it's best to get ahead of it. Take care.